46 trillion is the value of the US bond market. And that value determines what happens to cryptos like Stellar XLM. Is Stellar XLM going to go up, or is it going to continue going down? Its current trend at the moment is just consolidating. Other cryptos have been going up, like Binance Coin, like Ethereum. So why isn't Stellar XLM going up when the stock market is clearly going up? When we're in this period of stagflation, why isn't it having the same reaction? Well, firstly, I'll clear that up a little bit, and then we're going to jump into these charts, because this is part 3 of the technical analysis when it comes to the yield curve. But really, if we're entering an altcoin season because of this period of stagflation, which is seen to be as stock market positive and therefore crypto positive, and Bitcoin has lost its dominance and is seen to be going further down, whereas other cryptos are gaining dominance, this is the key. This is why the fact that Ethereum is moving up along with other cryptos, other altcoins, is an indicator to us that the whole altcoin market is going to move up. But I say this because you want to understand why Stellar XLM isn't moving up. It doesn't move up first. It's never been the first mover. Just like XRP, when they start to move, they go boom. Every time you see a meaningful move from Stellar XLM, it is fast and hard. Just like XRP, like a rocket ship, you'll get 3-4 big green haramis in concession. I mean candlesticks, if you don't know what harami is. And that will take us up into new all-time highs. But how is this going to come about? We know that we have this period of stagflation, but can we actually prove this? Can we see where the yield, how the yield curve is going to affect the stock market, or how the 10-year yield is going to affect the stock market, and how the stock market will affect cryptos? So to do this, we really need to look at the charts. Okay, so to continue where we was from before, let's go back and let's look at the money velocity. Okay, the chart on the money velocity, what's going on with, is the money coming into the economy? Doesn't seem so. Let's look at the chart to find that out. The M1 chart, we could see that the money's been printed and there's so much money gone somewhere. So let's have a look at real data like households and corporate credit, and we'll do that comparison with Joel's video where he pulls that data out, and we'll see if there's any sort of continuation, or are we getting the plateau, a potential period of stagflation where we've got a bit of decrease inflation. Not to say it's not going to go back up, but it's going to decrease and then move back. So find the floor, move back up, find the floor, move back up, and then hopefully trade in between this range that it's continued to do so over the last decade, I guess. So over to the charts. All right, so I know I said that we was going to jump to the M2, but I just wanted to jump to the M1 just to show you that obviously during COVID times how much money was printed. So 2020, so you could see clearly that all that money was printed, and then after it had stopped, the Fed had eased up quantitative had gone into quantitative tightening. Then it sort of plateaued at this period here, March, I'd say, when the rate started to go up. Yeah, so quantitative easing had tightened up, boom, and then the rates, interest rates, which central banks lend to each other, had gone up. So basis point after basis point. Now we're just going to jump to this chart, which is the money velocity chart. Now, what is the money velocity chart? The money velocity chart is a chart that tells us, that indicates to us what consumers are doing in terms of actual real spending. So where the consumer price index that displayed to us in the previous video, how much things are costing more in an urban environment, all US urban environments. And now this money velocity chart tells us how much money US consumers are spending. And as you can see, from the 90s, from the dot-com period, it had absolutely tanked. So since then, and then we had this sort of uptick back in at around, or it sort of moved in a channel back in around 2000. And then at 2008, when we had that crash, it's just dropped literally pretty much straight down with a little bit of a bump on the way. And it's been the worst it's ever been, since records have began. And really, consumers aren't spending. That's what this is saying in the USA. But more money has been printed, as you could see in the M1 chart. And the money's going somewhere else. So where is this money going? As I said before, the money seems to be going, and we'll do the comparison with Joel's. It seems to be going into non-financial corporate business debt security liabilities. Let's have a look at what that's doing. Wow, massive uptick since the 1970s. You could see clearly that this is where this money is going, into corporate debt, massive amounts of money from there. Let's see what's happened in 2000, if we've got any sort of pattern there. So from 2000, you could see the trajectory sort of plateaued out a little bit. 2001, obviously that was the dot-com bubble, where credit wasn't easy to get. And then from 2000 and I want to say 2004 or 5, 2005, around that time, say 2006, the trajectory just changed course again massively. Look at that, 2006, boom, and it just hasn't stopped. It's just gone up. Corporate debt has just gone up completely, and it's only really since COVID, it's only really just sort of slowed down. And I wouldn't even say that it's plateaued. It's actually gone up even more since last year October. It had a break, and then it's flown back up. So we know that money is flying into, or value is flying into corporate businesses. That's debt, securities, liabilities. It's flying into there. And also, we discovered that this debt is going into households and non-profit organisations. So they're accruing more debt, and this debt just, again, since the 1970s, just flown up. This is where all the money is going. It's not consumers, it's going into debt. More debt's being created, and this is where the debt lives. So we can see clearly we had this plateau at around dot-com bubble, let's just say. No, housing bubble, housing crisis. So that wasn't so easy to get. So it dropped off, and then come 2013, it started to trend upwards again, and then obviously just hasn't stopped really. It's just continued to go, moving further and further up, and it's not likely to stop. So this is where the money is going, and really we can compare it to Joel's, but I don't think there is any need. We'll jump over to his charts and see the difference. You can see we're at 8304 on the household and non-profit debt, and on the corporate non-financial corporate businesses we're talking 7520774. So, you know, it's, let's see what his charts are saying, and we can clearly see the trajectory's just continued up anyway. But we'll go back to Joel's.
More money was created through the last couple of years, throughout the COVID pandemic. Huge amounts, of course. Now we'll also look into actual debt levels, okay, because that money must have gone somewhere, it must have been loaned somewhere, without kind of going into the nuts and bolts of it. But when you create money, you're creating debt essentially to some degree. So we need to look at where has that money gone. First place to look at is the corporate businesses. How much debt have businesses taken on? Well, quite clearly, don't need any explanation other than to say that the debt levels for businesses are at all-time high levels, okay, and only ever getting more and more and more. Where else has that money headed to? It's gone into households. So households at the moment have some of the highest, well, they're of all-time high debt levels, and that is, to put it into comparison, approximately 20% higher than 2008 levels, of which we saw the mortgage crisis, because essentially many households over leveraged their finances into housing and all the rest of it, okay, sort of housing bubble and things like that. House prices were going crazy back in 2008. Well, I think I'll leave it up to you to decide what house prices are doing today.
Okay, thanks again for that, Joel. And we can see that the trajectory has not changed. There is some curve when it comes to the CPI data. So that would be consumer prices are curving slightly. You see that. How that's going to stay, I don't know. The likeliness is inflation's going to continue the trend, right? As always, it's been trending like that since the 1970s, 60s even. Not going to stop, because more and more debt has to be issued. That's just the way of it. The dollar is a debt-based unit, if you don't know. And this is how it works. The Federal Reserve will keep printing money. This will keep increasing the price of things. Government's responsibility is then to ensure that wages are at a significant level to be able to service the debt. A responsible level. And when we look at the stats, the statistics, when we look at the fundamentals affecting the crypto market, the Forex market, that being the Dixie, we can see clearly that money velocity is not going in to the general public's pocket, because they have less and less and less purchasing power. It's going into corporate debt, and I suppose you could say in some way it's going into the general public's pocket because it's going into housing debt. But by the by, the general public have less purchasing power because you can clearly see that everything costs more from the CPI data. Money velocity is not flowing into the consumer's pocket because the dollar is rising. When the yield rises, the Dixie rises. So, as treasury bonds are getting sold off, the yield rises. As treasury bonds get bought up, the yield drops. And we need the drop, we need the yield to drop, because that is stock market positive and it is crypto positive. You've only got to look at the charts from when Joel was talking back in November 2021 to see where cryptos and stock prices were. Much higher than they are now. It is slowly climbing back up, but at the moment, today as we speak, the dollar is at 107, which rose from 105 a couple of days ago. So that's climbing again higher and higher. We're going to keep an eye on the 10-year yield head and shoulders pattern. We want to see if that gets invalidated. If it does, we know where that's heading. Okay? If that comes out of that range for a significant time, we know stagflation is potentially still on the cards, but it's out of whack. It needs to trade within that zone, sort of between 1.5, 1.05 and 3%. So we're inside the zone, but we're on the higher end. Yeah. So if that yield, when I say trading, if that yield percentage is at in that zone, we could consider that zone as being stagflation. And I think if we're moving inside that zone, we've got a downtrend to happen before another uptrend. That downtrend is massively inflationary positive, which is not good for the economy because things cost more, and you'll see a reflection in the CPI data. So if it goes down, you'll see that, but what you'll also see is the stock market go up, and you'll see the Dixie come down. If the Dixie comes down, the dollar, then purchasing power in the USA abroad is decreased. So, with having said that, you can now understand how the 10-year yield affects cryptos. If it is stock market positive, Dow Jones positive, then it's positive for Bitcoin. And Bitcoin is a deciding mover and driver in the crypto markets, and you'll see gradually over time it will lose dominance anyway, as you'll get more and more use cases for other cryptos like Stellar XLM, like XRP. So yeah, you'll see that trillions will flow into Stellar XLM, and I'm going to point you to another video. But for now, I'm Nathan, aka Nathan of Zion. Smash the Zion coin up there, like and subscribe, and check out the next video, because we're going to be looking at one video I did before, Navati, and see what the use cases are. Have a great day. See you in the next one. Take care now.